Consumer credit is on the rise, growing 4.7% in January. This comes as credit card and auto loan delinquencies are still rising above pre-pandemic levels, according to the New York Fed. Here with more on the dubious health of consumer credit, let's bring in VantageScore CEO and President Silvio Tavares. Silvio, good to see you here. Help us make sense of where the consumer is right now, just based on the credit data you're pulling.
Brian, thanks for having me on. The really important key point is that the consumer is actually pretty healthy. We measure credit health by the average VantageScore, and that average VantageScore is 701 through the end of January. It dropped a bit of a point mid-year last year, and you could see the credit health deteriorating. But now the average consumer is doing really well. But what that masks is a little bit of a separation between consumers. That VantageScore prime tier, which starts around VantageScore 620, that's the main area where banks are lending. That tier is shrinking. We're seeing people go up or out. Some are dropping into VantageScore subprime, and others are actually going up into VantageScore super prime. And that has some pretty important implications for lenders, but also some pretty important implications for an election season.
What are those implications, Silvio?
Well, I think the key point as it relates to banks is banks have to be more picky. If you look at VantageScore consumers dropping out of that prime tier and dropping into a lower tier, that means you really have to be careful about who you're underwriting to, because you don't want those delinquencies that you just referenced increasing. But at the high end, for those consumers that are actually going up into the super prime tier, that's great news, very creditworthy consumer. But the challenge is all banks want that consumer, and so they're competing more aggressively to get that higher end consumer. It means more cost to acquire that customer if you're a big bank. So more competition at the high end and more risk at the low end is how banks are looking at it. If you're a politician and you're looking to get elected this November, either in the House or in the White House, what it means is your political message has to be attractive to both ends of the spectrum. That's hard to do because you're catering to folks that are doing really, really well and increasingly well at the high end, and also some consumers that are under pressure, continued pressure, because of those sustained high prices due to inflation, and also sustained high interest rates, making credit more expensive.
Well, I wanted to get you to dig into a little bit more where you're seeing the pain amongst those consumers that are falling into the subprime category. You mentioned some of those pressures, but kind of specifically, or as specific as you can be, what are we seeing happen with those folks? Why are they falling down?
Well, the real reality is that the average consumer falling out of the prime tier is a consumer that's generally younger, that is generally less affluent, typically doesn't own a home. And those consumers have less of a cushion to weather the economic shock. The reality is, if you look across consumers, overall, they're doing well, but this segment is struggling, and it's struggling not in just one type of loan, let's say credit cards. Delinquencies we're seeing increasing for credit cards, for auto loans, for personal loans, for mortgages, really right across the board. And it's not just getting worse from a month-over-month basis if you compare January to December. It's also getting worse if you look at it on a year-over-year basis. So the credit deterioration is quite broad-based across all credit products, and also across all credit vintages when the loan was made. And of course, that's a sign for concern. It's a gradual worsening. It's not happening all at once. But of course, when you see that kind of broad-based deterioration in credit quality, of course, that's a cause for concern, and we're watching it very closely.
Silvio, should we get a couple interest rate cuts this year? Do you see consumers going back to spending beyond their means?
Well, I think the reality is that we look at the year, and this approach that the Federal Reserve has taken of really staying the course and engineering that smooth landing, that is actually working. And so that's great job to the Federal Reserve. But I think the reality is, if you look at the year to come, there's definitely some cause to concern. There's going to continue to be pressure on the consumer, including the low-end consumer. Also, specifically around student loans, we're going to see that younger, less affluent consumer come under pressure. So I think the rest of the year could be pretty bumpy. Federal Reserve, I think, is probably going to make one cut, but even that cut, I think, is under question because there is pressure. But the reality is the economy, as I mentioned at the top, is still doing pretty well, and the overall average consumer is doing pretty well at an average Vantage score of 701. So we're watching that. I think we're all going to be watching the high frequency data on a monthly basis to make sure that we're not missing anything.
Indeed, and we'll have you back to go through that. Silvio, good to see you. Thanks for joining us.
Great to see you again, Julie. Thanks for having me on.